Hello and welcome to AI Market News by LM. Today, a geopolitical storm is brewing over Greenland, and believe me, it is putting global markets on high alert. We're seeing some truly unprecedented moves in everything from gold to government bonds. So let's dive right in and break down what's happening and why we should all be paying attention.
So let's start with this. This quote from a European leader, coming from various news commentary, really sets the stage. It perfectly encapsulates the escalating trade tensions we're seeing. And this isn't just diplomatic back and forth, folks. This is a clear warning sign that the economic stakes are getting incredibly high. All right, let's get to the heart of it. Based on the prepared resources, the core of all this market anxiety stems directly from these US tariff threats against 8 European nations over Greenland. And just like that, the market has flipped the risk-off switch. It's that classic reaction, you know? Investors are dumping anything that looks even a little bit risky and scrambling to find a safe place to park their cash. And make no mistake, Europe isn't just sitting back and taking this. The European Union is apparently preparing a pretty serious countermove. We're talking about potential retaliatory tariffs on a massive 93 billion euros worth of US goods. We're literally watching a tit-for-tat trade dispute unfold, and that could have huge consequences for the global economy.
So the big question is, where's all this nervous money going? Well, the initial reaction has been a textbook flight to safety. With so much uncertainty swirling around currencies and stocks, investors are piling into precious metals. It's that age-old move. In times of turmoil, hard assets tend to feel like the only sure thing. And this picture just says it all, doesn't it? It perfectly captures the market mood right now. This isn't just about numbers on a screen, it's a desire for something tangible, something real. When geopolitical tensions get this high, there's an instinct to own something you can actually hold in your hand. And that is exactly why we're seeing gold and silver prices soar.
The scale of this move is what's truly remarkable. We're not talking about gold just edging up a little. It has completely shattered its previous records, blowing past $4,700 an ounce. Wow! A move of this magnitude, it signals a really deep-seated anxiety in the global markets. And hey, this isn't just a gold story. Silver is right there with it, hitting its own record high of over $94 an ounce. The fact that both are rallying so hard tells us something important. Investors aren't just hedging against one specific problem, they're looking for broad protection against all this volatility. Okay, so we've seen the rush into metals. Now let's pivot to the currency markets, because this is where the story gets a lot more complex. These geopolitical tensions have basically thrown gasoline on what some analysts are calling the Sell America theme, and that is putting some serious pressure on the US dollar. So here's the key thing we need to understand: the growing split between the US dollar and the euro. The dollar has taken a beating, down 10 to 12% from last year. It's getting weighed down by the US's twin deficits. That means both the budget deficit and the trade deficit. But the euro, it's shown some surprising strength. It seems the market is looking at this whole situation and thinking, you know what, this feels like a dollar problem. Now, over in Japan, the yen is in a really fascinating spot. Normally, in a risk-off environment like this, we'd expect the yen to strengthen as a safe haven currency. But instead, it's just kind of holding steady around the 158 level against the dollar. It's like it's caught between its safe haven reputation and all the economic pressures happening at home. And this is where it gets really interesting for anyone trying to read the tea leaves. On the surface, the yen might look cheap, but the options market is telling a very different story. Traders are actually pricing in a 40% chance of even more weakness, maybe down to 165 by June. It sure looks like the smart money is betting against a yen recovery. These shockwaves are also being felt in the global bond market. And nowhere is this more dramatic than in Japan. We have to remember, this is one of the largest bond markets in the world. So when it starts to shake, everybody feels the tremors across the globe. And just look at this chart. It really says it all. That is a dramatic, near-vertical spike in long-term Japanese bond yields. This is not a gradual adjustment. It's a clear sign of a market in turmoil, with intense selling pressure and a huge repricing of risk happening in real time. To put this into perspective, Japan's 40-year bond yield has surged to over 4.2%. That is a level we have not seen since 1995. Think about that for a second. This is forcing a complete rethink of how investors allocate their assets, not just in Japan, but everywhere. So what's driving this? Well, it's really a perfect storm of domestic factors. There's political uncertainty from a snap election called for February 8th.
We have political parties talking about consumer tax cuts, which means more government borrowing. And on top of all that, a recent 20-year bond auction was met with pretty weak demand, which just added more fuel to the fire. Okay, so currencies are wild, metals are soaring, bonds are in turmoil, but what about the stock market? That's the billion-dollar question, right? Are we seeing full-blown panic in the S&P 500 and the NASDAQ, or are investors managing to hold their nerve through all this? Let's find out.
One of the best ways we have to gauge the mood of the market is with the Fear and Greed Index. I love this tool. It's basically a mood ring for the stock market. It takes 7 different indicators and combines them to tell us if fear or greed is the dominant emotion driving investors.
So what does the index look for? Well, in simple terms, it starts flashing fear when we see a few key things happen. First, higher volatility. That's the VIX, or the market's fear gauge getting jumpy. Second, we see investors favoring safer bonds over riskier stocks. And third, there's a rise in investors buying put options, which is basically a way of hedging against a potential market downturn.
With the market landscape shifting so quickly, it is absolutely crucial to keep an eye on what's coming next. So let's turn to the economic calendar from investing.com to see what key data releases could drive the market's next move.
All right, scanning the calendar. The one we really need to circle in red is the German ZEW Economic Sentiment Report on January 20th. This is going to give us our first real insight into how European businesses are feeling amid all these tariff threats. A weak number here could easily accelerate that risk-off trend and put even more pressure on the euro. And all of this leaves us with a pretty provocative question to think about. As trade disputes are turned into geopolitical weapons, is the very definition of a safe haven asset being rewritten right before our eyes? With the US dollar under pressure and even the Japanese yen facing headwinds, we have to ask ourselves, what does a true safe haven even look like in today's market?
Now for a quick disclaimer, this video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks so much for watching. If you found this helpful, don't forget to hit that like button and subscribe. We'll see you next time.